14% of Australians own an investment property. Who are these people who've got 5, 6, 7, 10 plus properties?
Each house is its own little business.
How on earth can they possibly do that?
And if you can put all your savings into offset mortgage accounts, every dollar you put in is definitely decreasing the overall. It's a really large chunk of money.
Welcome back to Brick to the Future, Australia's #1 property investment podcast. You like what I did there?
I did.
I'm AL Lewison and this is Khaysan. Thanks for joining us again, Khaysan.
Thanks for having me, Al.
I feel like we're treating you a little bit like ChatGPT at the moment. It's like, okay, Khaysan, come in and act as our resident tax expert today for the show. And you come and dazzle us with your tax knowledge. So thank you for joining us.
No problem.
So we're going to cover some very important things and very topical because end of financial year is tax time, bit of tax planning for people.
Yeah.
And the things we're going to cover off are what we wish we knew earlier and what we've learnt along the way. That's more you than me. Mm-hmm. Smart tax strategies can ease cash flow pressure from holding properties. And then we're going to break down some practical ways to reduce the real cost of owning property, which is the real brass tax and what we're going to talk about today, which is helping people hold more properties through using smart strategies with tax. So thanks for joining us.
No problem.
So the first one that we're going to talk about is things you wish you knew earlier. Probably lots of things in your life, but this one's specifically related to tax. So do you know off the top of your head, what are some of those things?
I think first and foremost, the benefit of property for tax. I don't think until you look realistically at the actual figures, I don't think when you're young, you connect the dots. So like the value of a property on paper versus in reality and how that actually affects your tax return. For myself though, I always like to hire people, I guess, who are experts in their field. So what I came to realize like really early on is that when you're dealing with property and you're dealing with multiple properties, just going to your average tax agent isn't probably the best way to get that result. Like most professions within sort of our industry, not everyone is created equal, even though they all have the same degree. Some people go into different areas of tax. Might be company tax, it might be investment tax, everyday tax for the pay as you go, PAYG.
Well done.
So making sure that you're getting a tax agent that deals specifically with property and understands the ins and outs.
So you bought your first property at 25?
Yeah, 24. Yep.
24, sorry.
That's okay.
And I think you, like everybody else, when you look at it from the outside and you look and go, who are these people who've got 5, 6, 7, 10 plus properties?
Yes.
How on earth can they possibly do that?
Mm-hmm.
Particularly someone who might own their own home and they're reliant on themselves to pay for that home, pay the mortgage. It's very different once you start to put some layers in, and a big contributor to paying that mortgage for people is tax breaks. So how do some of those tax breaks work? Like, do you know some of the numbers? I think you rattled some off the other day. I'm not sure how reliable those are.
Yeah, I rattled some off for a specific client. So, for example, for someone that earns $220,000 per year, which that's a higher income, roughly you'd pay about $65,000 in tax for the year. Per house, you can actually knock roughly between $20,000 to $25,000 off that $65,000. So we always work in blocks of 10 years because our goal, obviously at OpenCorp, is to get people's properties to double within a 7 to 10 year period. So when we look at investments, we look at it in that decade block. So over a decade, someone on that particular wage would be paying about $650,000 in tax. So you can knock off on a 10-year period by using the right strategy and having the right people working with you about $200,000 to $250,000.
This isn't tax advice and this isn't financial advice.
Absolutely not.
And we'll probably caveat this as well. Like, it's not linear, so you get more in the early years than later years. But let's use some round numbers.
Yes.
180 to 250, somewhere in there, you might get a tax benefit.
Yes, over a 10-year period.
That's a lot of money to help pay for your property, isn't it?
It is a lot of money, and it's also just one property.
Yes.
So if you're duplicating, if you're purchasing, and you're building that portfolio, which is obviously the goal, it's a really large chunk of money. Absolutely. So that's when you're in the negative gearing phase. So as you said, when you're early into the journey, long term, the goal is to get them giving you passive income.
Yes.
And tax changes again. So, for myself, as you said, that property I bought at 24, for the longest time, it was negatively geared. When I did my tax last year, I realised that I'm actually about between 18 and 19,000 up on that per year. So that one's actually clicked over into it's making me money now. It's adding to the bottom line. So, and that did that in that 10-year period. So that's essentially what the goal is, but just understanding the different stages is really key.
The term I'm about to use, it's taken on a new meaning recently, and I mean it in the new meaning way. So some people will claim their tax back as they go. They'll put a withholding statement in and they'll get a weekly, monthly, fortnightly, whatever they're paid in, benefit in their tax. Others raw dog it and just take all the savings at once a year.
Yes.
I always take the savings once a year. I sort of saw it as enforced savings, and I'm like, if I can afford the repayments, that's a holiday for me. I'll get my tax back, and great, I can go on a nice holiday. What did you do in the early days? Did you raw dog it, so to speak, or did you claim it as you went through the tax withholding statement?
Before I knew any better, raw dogged it.
Okay.
Now I know better. I get the variation back. Even if I don't need, I get the tax back via the variation in my pay monthly. Even if I don't need the money, which depending on the types of rent you're getting as an investor and your wage will be the difference in how much you get back. So, so some people, they're out of pocket $100. Some people are only out of pocket $20 from their actual wage. So depending on that type of information, everyone varies a bit. But I now use the variation because what I understand is you can offset your loans. So you can put all the money that you get from your tax into an offset account against the mortgage that's paying the bills. And it decreases your month-to-month payment. So you don't necessarily need the money as such to pay the mortgage, but building it up as a saving is key. What
a massive benefit. So if I understand this right, you get the benefit, you put it into an offset, you pay less interest. Your mortgage period, if you looked at across the 30 years, has decreased enormously.
Yes.
Wow.
Yeah.
What a great way to do it.
It's absolutely a really big saving. And if you can put all your savings into offset mortgage accounts, even if you need to take the money out, you still can. Every dollar you put in is definitely decreasing the overall.
That new raw dog term,
yeah.
The first time I saw it used was someone on a flight said, I've just raw dogged 12-hour flight to LA, which meant they just sat there without any entertainment, without reading a book, and stared at the seat in front of them.
Which actually feels as fun as doing your tax, doesn't it?
Probably does feel just as fun. All right, so I think we cover this most years, pretty topical, and it's an important one that every year people take steps to make sure they're maximising the tax, but it's not only tax time, and there's things people can do throughout the year, right from the second they start on their journey.
Mm-hmm.
I want to play a little game. I'm going to call it Tax Time Bingo.
Okay.
I've got a list here, thanks ChatGPT, of 10 things that people could do to save themselves from tax. You're talking to clients every day about this and what they can do.
Yeah.
Let's play a little tax time lotto and see how many of these you can get, and I'll top how many others.
Okay.
And by the way, some of them are a bit abstract. I don't really agree with them, but let's see how we go.
Okay, cool. Are you saying you know more than ChatGPT?
I doubt it. Might be more relevant ones I know.
Okay, cool. So first thing I do, client rings, I ask them how long they've had their accountant. So just get a really good understanding of, I guess, the depth of knowledge your accountant has, and if they've got a lot of other clients that have investment properties. Because as I said before, not all accountants are created equal when it comes to tax. So absolutely, we're doing a expert check when they're calling in. We're in the first thing they're talking about tax.
Bang, done. That was number 10 on the list.
Okay, cool. Second thing is, have you been doing the tax variation, which is essentially getting the depreciation of the house back in your pay compared to at the end of the year. So that one's more when people are talking about holding costs. I would check in where that is.
You know what? ChatGPT didn't have that one. That's a great one. That makes a massive difference for people.
Yes,
Yep.
it absolutely does. The third thing is be as diligent as possible with all your receipts and all your costings. That's really important, because everything is basically claimable. You almost look at it as if it's a business. Each house is its own little business, and majority of your costings are going to be tax deductible. So if you're ever spending money, you have maintenance, you have council rates, you have water bills, sewerage bills, that type of stuff, all tax deductible. So making sure that all of that is getting packaged up, going to your accountant.
How are people doing it to make sure they capture everything? I mean, the old days were put your receipts in a shoebox and pull them out at tax time, but that's obviously gone with email and internet and whatever.
Yeah.
What are people doing?
So personally, a specific email for investment properties, and every time a bill comes in, put that bill directly into that particular properties folder.
Yeah, I've got a folder, the same folder for investment properties, folder by property, and then folder by year inside that property.
Yep.
And I'll just put everything in for that year.
Absolutely.
And very easy to find.
And then it literally send it over to your accountant.
Hate those freaking paper bills. You got to scan them. You got to put them in.
Yes.
But well worth it. Comes tax minute hunting around. You just go.
Absolutely.
There you go.
Absolutely. I think also, I mean, it's probably a bit premature to actual tax time, but understanding your loan structures, a lot of them are tax deductible as well. Depending on what strategy you use for properties, some of the items, through acquiring property is also tax deductible.
Yep, so I'm going to call that, ChatGPT said, offset rental loss carefully, which is negative gearing stuff. So make sure you're recording properly what your interest is.
Absolutely.
What your rents are, what your outgoings are.
Yeah.
Good.
So they would probably be the main ones that we would talk about.
Okay. There's some nuance between repairs and improvements.
Yes, that's a big one.
Improvements aren't tax deductible. Repairs are tax deductible. Yes. So people have to be careful with what they're calling certain things and make sure that they're compliant with what the tax codes are.
Yes,
so
absolutely.
I think that's important people do that.
Yes, I do. I think also, a little off topic, but on topic, a misconception is that by adding to homes, you're adding value. From a investment point of view, pending everything's up to code and the house is livable and nice, we would just say that's overcapitalizing. So, and that from a tax perspective is understanding where you just need to keep the house livable, up to code, fresh, compared to adding a patio because you think it looks good.
And for any naysayers listening who say, no, that's not 100% right, if you do an improvement, it adds to your cost base. And when you sell the property eventually, you do get a tax advantage then. So just to tick every box there you go. A couple of others that were on here. Did you talk about get a tax depreciation schedule?
In the first section, did I talk about that? So I might not have been clear. To be able to put the variation in with your accountant, you need the depreciation schedule. And the depreciation schedule, the easiest way that it's been explained to me is basically all the costs that are on paper get put into your accountant, and that is where they take the variation figure from.
A couple of yours have probably gone into a few buckets in here. There's two here that I don't necessarily agree with. I think people need to worry about. One is prepay expenses where suitable. So if you know you have an expense in a business respect that's upcoming, you can accrue for that the year before. I think it's unlikely that property investors are going to be doing that. Maybe unless they've got some big repair bills coming, but probably not relevant ChatGPT. And the only one
I would say it might be relevant for would be landlord insurance. Maybe. Yeah.
So there might be ways to do it, and that's probably one you talk to your normal accountants, a created equal accountant, and just say to them, is there anything here annually that I could be accruing, bringing forward? And the other one was, you've got to be smart with co-ownership splits. So it's probably a bit nuanced in who that applies to and how it works. But again, you would talk to your accountant, make sure that under your structures you're getting the right tax. But
absolutely,
that rounds out what ChatGPT thought were the most relevant, and you knew most of them. So well done, Case.
Yeah, thanks very much.
Bingo. Ding, ding. So, Case, we've covered a lot of things, but I think there's three really important elements that make not just tax planning, but maximising your tax benefits and enhancing your ability to grow your portfolio. They are going to be negative gearing, they're going to be your tax variation withholding form, and they're going to be having the right team, in my opinion. Those three things, if you get them right, you'll go a long way to being in the small percentage of Australians that own multiple investment properties.
Yes.
And let's not forget, 14% of Australians own an investment property, and you're up to about 6% who own two or more. So the people who get it right, if the structure's right, and let the system work for them, go a long way to being in that 6%. So if we talk about the first one, you've covered it today, but let's just summarise it again. And I think got some numbers here if you want to roll through them, is the negative gearing aspect.
Yes.
So give us a really high level for the uninitiated on negative gearing, how they can maximise benefit and take advantage of it.
Okay, perfect. I am going to use the notes very specifically, Al, just because I don't want to get this wrong. And sometimes when you know something and, other people don't, you don't explain it well enough. So I want to do it justice.
And Ben and Louise put a lot of time into it. They get angry if we don't. So let's use their numbers.
All right. So easiest way to understand it, your annual rent, $30,000. Love that. Expenses, and when we say expenses, we're talking loan interest rates, maintenance, etc.
Cost, all the things we covered before.
Everything that we covered before. So about $10,000 a year. So that takes it up to 40. So the shortfall between rent and overall cost is that $10,000.
So your total income's 30, total expenses are 40.
Yes.
Okay, 10,000 difference. Got it.
Yeah. So if you are on 90,000 taxable income per year, Al, and you use that on paper deductions and put them into your accountant, to the tax agent, they take $10,000 off that shortfall between the annual income and the annual expenses, and they only tax you on 80,000. So when we say you're getting tax back, you're not getting it back in your pocket the same way, you might get a rebate from something, hardcore cash. You're paying less tax on your wage. So that's when we say you're getting tax back, you're technically paying less tax.
Okay, so you can do a tax variation withholding form. We'll talk about that in a moment.
Yep.
And your tax saving is X dollars per year off that 10,000 of reduced income.
Yeah.
You could take that if you paid monthly installments, so you got extra cash in your pocket.
Yes.
Or you could do to the raw dog style, like I said, and just save it at the end. And
save it at the end. Yeah.
Okay. So I think your point before was an amazing one and really well thought through. You do the tax variation form. And you put it off your mortgage.
Yes.
So let's just use the numbers here
Yep.
to explain exactly with some real numbers how that would work for a tax variation form.
So basically what happens, your accountant estimates the $5,000 refund based on deductions. You submit the form and you get $100 back per week.
So your pay packet goes up by $100 in your take-home pay.
In your take-home pay. So the really important part though, Al, and what you have to be diligent with, don't spend the $100. You've got to put the $100 into an offset account against your mortgage. So if your mortgage was $100,000, for example, at the end of the first week when you put your $100 in, you're up to 9,000.
Because interest for the bank, is calculated daily and charged monthly. So any day that you can put small money in, you charge less interest overnight on that money.
Absolutely. Yeah.
So Johnny has gone through the two steps. He's got a negative geared property. He has a rental income of 30,000. He has costs of 40,000. He's got a shortfall of 10,000. We covered that negative gearing.
Yeah.
He's gone to his accountant and they've arranged that he'll put a tax withholding in. He gets a 5,000 saving per year, taken weekly, $100 a week. So instantly saving money. The really important thing here, which is the last point to making sure your journey is successful and you're in that 6% who can have two or more properties, is the right team.
Yes.
Because if someone goes to the wrong accountant, gets the wrong advice.
Yes.
If someone goes to a barbecue, talks to the wrong guy. If someone doesn't have a well thought through plan, what happens? So what's some guidance you give to clients and that you've taken yourself in getting the right team?
To be honest, Al, I always look for people that are doing what I want to do better than me, and I see who they're working with. Yeah. So I think there's some things in life, property being one, money management being another. Unless someone is actually achieving what I'm trying to achieve, their opinion means very little to me. So I'm going to experts. I might go to yourself. I might go to my parents, my mentor from my old life, people who I know have done well in areas that I respect, and I ask, who they're using, essentially.
I think one of the little known additional benefits of being a client of OpenCorp is that we've probably made the mistakes.
Yes.
Like we've built the team over a long period of time.
Yes.
Our clients get access to that. They can say, who do you recommend? And we've got, several different accountants that will say this person or that person, and do your own research, but here's some people we recommend. Yeah.
I also take clients' feedback very seriously, because I recommend someone, they have a great experience. They tell me what their savings are. So then I feel comfortable to keep recommending people. So we absolutely do have a really good base of experts in most areas, whether it's accountancy, SMSF, setup and strategy. We've got business partners in all aspects. But if my, clients tell me about something great that they've done in regards to their property that I might not be across, or, I take that feedback seriously, because they're all trying to get to the same place. So good feedback from people who have been using services we recommend is a great indicator as well.
What's the biggest tax withholding you've heard for a client? Do you know? Don't say the client if you know numbers. But
no, I do. I actually did a little bit of prep myself, and we got a $43,000 tax back for a particular client that we had over in Perth.
You're kidding.
And it was an adjustment over a 2-year period. So made the mistake of not getting the right information early, went to one of the specialists that we deal with. He had an adjustment. He ended up getting back interest through construction. He ended up getting tax back on the OpenCorp fee, but across the 2 years, he got the $43,000. So pretty instrumental.
Actually, that's what I hear that a lot. Claiming interest during construction.
Yes.
It's a hot topic with accountants.
Yes.
It is allowed.
Yes.
But there's some nuances to how it's allowed. Yeah. But regularly I'm hearing clients saying to my accountant said, absolutely not. No, sorry. And there's quite a saving to be had.
Absolutely. And this is why we say not all accountants are created equal.
I used to say, and you can apply any profession to this, and I'm sorry to the accountants, what do you call a carload of accountants on the bottom of the ocean? A good start. I'm not sure if the accountants would like it. I don't really say it. I just made that up on the spot. But it's important to get the right accountant. And I think to summarise, some key points from today are smart tax planning helps investors hold more than one property.
Yep.
Depreciation and negative gearing can significantly change the outcome of someone's life if they get that right and use it properly. Withholding variations help you sleep at night, go on a holiday, live your life. Life's for living. You don't want to get yourself, under the screws because you're trying to hold an investment property. Use the tools at your disposal to get more tax in your pocket. The right accountant's important. Accountants are very good at what they're doing, great people. And property investment is possible without screwing your everyday life. We've talked about that.
Absolutely.
Thanks for joining us today. It's been great, been insightful. You did amazing.
Thanks for having me.
Thanks. Bye.